Hello YouTubers, and welcome back to part 2 of the market update for November 11th. I was just talking about high yield bonds and how it shook the market a little bit last week. And also in the Wall Street Journal, there's some of the big banks are starting to shift some of their, Barclays for example, they're going to estimate about 20 billion euros. They're going to move or migrate from high yield investments over to more secure investments. So they're getting a little bit concerned that maybe yields got a bit too high, and if the economy slows down, there's going to be increased risk. Another side of this is companies that want to buy finance through, and their rating through Moody's or S&P is low. They're finding it's more difficult now to actually get funding. So where there was so on one example here is NRG Energy canceled the refinancing. NRG offered a 5.75% yield, which is quite high and would be in the close to the junk rated bond at that yield today. But NRG offered 5.75 yield for new bonds due 2028. But that was at least a quarter percentage point too high for investors, according to people familiar with the deal. So it looks like investors now buying bonds are starting to shift up the interest rate they want on those bonds. So it'll be interesting to see how this plays out. So what I did, I've been watching this for a while, and so it's a JNK. It's an ETF of junk bonds, because like I say, the bond market's difficult to actually buy individual bonds, that type of thing. So, but I did an outright short position on JNK, and betting that the price will come down. So I did. I just did 2 contracts at $36, and I gave myself to next June. So once it drops through, and I already paid 80 cents for that, so at 35.20 down in here, I would start making money on that. So we can see here last week's sell-off was quite dramatic. This is a pretty tight scale because it's not that volatile, so it looks worse than what it is. But you have to remember that these are only paying maybe 3% or so, 4% interest, and then you get a price drop like that, it takes away your income gains quite quickly. And we can see back in the last crash how we went from 48 all the way down to 26, and then we've been in this very kind of tight range here. When the Fed tried to increase rates earlier, it drove this down quite a bit. So it's early days on this, and I don't know how it's going to play out, but I thought I'd take a little position now because the volatility right now in the like the VX, the VIX, all your volatilities are actually quite low in derivatives right now, so it makes it cheaper to open an actual long option. And if volatility increases, then that automatically brings the price up, and then as the actual position falls, that also is going to bring the price up. Again, I've said in the past, I typically do options more as credit trades for income, and I do this very sparsely because you have to get it. You can get the overall direction right, but you might get the time right because these all expire. So that's why I went up to June, because I figure by June there's maybe a good a good chance now that we'd see a correction in the equity markets and also the bond markets. So that's kind of on the upsets last week in the market. And the other big thing, of course, last week was oil. And we've had a fairly strong rally in oil this year. And you can see we've gone from 42 all the way up to 56, which is still kind of low. You know, when we, a couple of years back, were over $100. And of course, there was quite a bit of news last week, geopolitical unrest, and we, especially in Saudi Arabia, so we've so we had all the arrests in Saudi Arabia. The new prince there is trying anti-corruption sweep, and so crude. And it seems this new prince is really sounds like he's firm on decreasing the production rates in Saudi Arabia, and that should help. They are kind of the swing producer, I think. For every barrel produced, 1 in 9 comes out of Saudi Arabia, and so that if they can maintain or even lower their productions more, this might help keep the prices where they are. And there's also conflict between Saudi Arabia and Iran right now, and the whole Middle East is quite high level geopolitical risks. But that hasn't really, there's been no actual breakout in war, and that hasn't really affected the actual production yet. So we'll have to see how that kind of plays out. The problem is, as I mentioned before, as oil prices come up, then we see more of the U.S. fracking kind of come online, and with the U.S. being one of the biggest oil producers in the world now. It's really hard to know how this is going to kind of play out, because if you have production dropping in Saudi Arabia, bringing the prices up, but that might just be enough for these frackers then to generate enough cash flow to pay their debts, and then that offsets the price increase. So, but what I did, I did 2 speculative plays, and it's on the oil services, and the 2 companies that I did it on are the big players in the field, and it's one is Nabors, and the other one is Noble. So Nabors here, Industries. This is what I classify a turnaround play. The companies are probably going to continue to lose money maybe for the next year, and it's very dependent on the oil prices staying where they are and maybe going higher. And if oil prices did turn around and go lower, I'd probably sell both these positions at a loss, and I just opened a very small position. Somewhat on the technical side, as it looked like we've kind of based out on both of these, and the market, the stocks have turned around a little bit. And we can see Nabors, which symbols NBR in the U.S., was at $18, and it came down to about $6, and now it's up to about $6.40. I started buying at $6. I put a short put underneath for income, and what I did I didn't do a lot of research, that both these companies are trading below book value. And we have to be careful there, because not all assets are equivalent. For example, cash is cash. You can count that as 100% as an asset. But an oil rig, it's not going to be used again, or a low chance of it being used, is on the balance sheet it's bought at a price and it's slowly depreciated over time, and it doesn't really reflect the market value, so you got to be a little bit careful. But still, these companies are almost half book value, which is extremely rare on a market that's as expensive of this. And we can see if we go out on these, like on a weekly chart, this company was at $50 back when oil was, say, at 100, and now we're down to 6.4. So it's, to me, it's not too big of a risk. We're seeing a nice double bottom there, which it bounced off before back in 2016. And even if we get a run like that, it went from 5 to, say, 18, 300% or so, that would be quite good. I don't expect to go back to the $52 range or anything like that, because I don't think oil will ever get back to those prices in the near future. And same thing on, we can see here on Noble NE as a symbol, we went again from $60 right down to $4. So buying at these prices, I see kind of limited downside risk. I'll probably continue doing the short puts safely underneath for a little bit of income, and if oil gets to 65 or so, and in this what we're seeing, because oil prices have been staying low, which nobody expected, it's driven a lot of the small players out of the market, which is kind of nice. And now you're getting consolidation happening in the market, so these companies will have more control in the price.